Why is it important to consider all relevant cash flows and an ideal evaluation method for capital investment? Without considering every cash flow of a potential project, you do not know how the project will enhance the value of a firm. You need to include all the cash flows coming from a potential project to understand how much value they will add to the firm. Telia is comparing 4 mutually exclusive projects. In order to choose the best project to optimize the goal of the firm, which capital budgeting method should Telia use? Net present value, NPV. When you compare mutually exclusive projects, you should look at how much value is added by each project, because you can do only one of them. Therefore, you should use the NPV method to choose a project. Alphabet Co. has $50,000 to spend on capital investment projects for the next year. It will do as many projects as it has cash for. Alphabet Co. calculates the potential incremental cash flows and costs of the projects, as well as the NPV, IRR, and PI for each project. How should the company decide which projects to invest in if it wants to maximize the total amount of value created? It should choose the projects with the highest PIs until all capital has been used. By choosing the projects with the highest PI, Alphabet Co. will be able to use its limited capital effectively to create the most overall value for the firm. What should an ideal evaluation method for capital investment consider? All the cash flows in the project, the timing of cash flows, and the cost of capital or risk of the project. When making capital investment decisions, which method is recommended as the primary method? Net present value, NPV. How should the other methods be used in conjunction with the primary method for capital investment decisions? They should be used to supplement the primary method. What approach should be taken when facing capital constraints while choosing multiple projects? Use the profitability index, PI, to rank the projects and decide based on the PI ranking. Why is the net present value, NPV, method often considered superior for making capital investment decisions? It considers all cash flows, timing of cash flows, and the project's risk or cost of capital. Why is the profitability index, PI, particularly useful under capital constraints? It allows for the comparison of projects of different scales by ranking them. What is opportunity cost as it relates to the time value of money? It is the opportunity you forego to invest in other options due to the time scope of an investment. Why is the timing of cash flows an important characteristic of capital investment? Timing of cash flows is related to the opportunity cost associated with those cash flows. The cash flows of an investment need to be compared to the cash flows of other projects. How does the concept of time value of money assist firms and individuals in evaluating projects? B. Comparing the relative value of projects of varying scope, size, and duration. When does a capital investment add value to the firm and its shareholders? If the present value of the benefits of the investment exceeds the present value of the costs of the investment. What principle allows firms to make informed decisions about capital investments by considering the value of money over time? The time value of money principle. Why is it important to consider the time value of money when evaluating different capital investment opportunities? Because it enables the comparison of the future value of investments' cash flows to their present value. What outcome indicates a successful capital investment decision based on the time value of money? The present value of the investment's benefits is greater than the present value of its costs. Why is there always a cost for bringing funds into a business? A business must compensate investors for the risk that they are taking to invest in the business. What is the relationship between the risk and the rate of return? The higher the risk investors have to take on, the higher return they require. How can having more debt benefit a company? Interest expense on debts is paid before taxes are calculated. Which example demonstrates a financing decision in a firm? How a company will fund its assets and operations, namely, what proportions of debt and equity the business will use. How do the required rates of return for investors vary within a firm? They differ based on the type of security the investor chooses, such as bonds, preferred stocks, or common stocks. What does the required rate of return for investors represent for a firm, the cost of capital, or the cost of raising cash for capital investment? Why might different projects within the same firm have varying costs of capital? Because each project has different inherent risks that change the cost of capital to the firm. How do tax shields associated with debt financing, such as mortgages and bonds, impact a firm's capital structure? They reduce the cost of debt, but do not produce an optimal capital structure for the firm. What is the relationship between the cost of capital and the required rate of return for investors? The cost of capital to the firm is equivalent to the required rate of return for its investors. What are incremental cash flows? Any additional cash flows, whether in or out of the firm, that are created as a result of accepting a project. How does allocated overhead affect the selection of capital investment projects? These cash flows are not a direct result of a specific project, but are a general cost to the firm. How are non-incremental cash flows different from incidental cash flows? Incidental cash flows are indirect cash flows that are not explicitly revenues or costs. Nevertheless, they must be included in the analysis. How does cannibalization factor into capital investment decisions? If your company is planning on launching a product, and that product is going to steal some of the sales of another of the company's products, that loss of sales could be an incidental cost or revenue caused by the new product. Which type of cash flows should be included when estimating the cash flows of a project? Incremental cash flows. What are incidental cash flows in the context of a project? A type of incremental cash flow that are indirectly created by a project, but are not explicit revenues or costs. Why should opportunity cost be accounted for in capital budgeting for a capital investment? Because a company loses its ability to use the same assets somewhere else. What are sunk costs in the context of project evaluation? The costs that have already been incurred and are irrelevant to the project evaluation. How should sunk costs be treated when evaluating a new project? They should be ignored because they are irrelevant to the project evaluation. What factors are essential to consider in the capital budgeting process for evaluating the worthiness of a project? The time value of money, the risk of the project, and all the project's cash flows. Which tool should be primarily used to evaluate projects in the capital budgeting process? The net present value, NPV. How is the profitability index, PI, particularly useful in capital budgeting? It helps in evaluating competing, not mutually exclusive projects under budget constraints. Why is the time value of money important in capital budgeting? It accounts for the opportunity cost of capital investment by making cash flows received at different times comparable. How does the cost of capital reflect the risk of a project? It accounts for the risk of a project, as investors demand a certain required rate of return given the level of risk. Which elements should be included when deriving the capital budgeting criteria to make a decision? Incremental cash flows and opportunity costs, but not sunk costs. A company is considering 5 projects that are not mutually exclusive. However, the company does not have enough money to do all of them. In order to prioritize projects that fit within the company's budget, which capital budgeting method should be used? Profitability index, PI. The PI should be used first to compare the projects and then to rank them to maximize the value of the firm. Comparing the initial outlay to start with the biggest project. Which scenario is an example of an opportunity cost that is not associated with cash flows? Albert decides to stay home and study for his test instead of going to the movies. The opportunity cost is going to the movies. Which condition indicates that an investment will add value to a company? The present value of the benefits of the investment outweigh the present value of the costs of the investment. If the project provides more value than it costs, then mathematically it will add value to the company. How do corporations and purchasers of financial securities view returns? Purchasers of financial securities look at returns as the amount of money they require in order to lend or give their money to the corporation that issued those securities. What is an opportunity cost? The loss of the ability to use an asset toward the next best project once you have invested it in another project. The concept of opportunity cost is that because you use an asset to invest in one project, you lose the opportunity to use the same asset to do a different project. What would an analyst predict for a potential investment with an NPV of 0? The project would earn exactly the rate of return required by the firm. An NPV of 0 indicates that a project will neither add nor take away value from a firm. A financial analyst for the company Bobby's Books has been asked to evaluate a potential investment using a method that considers the time value of money. Is there more than one way to do this? Yes. The analyst could use both the NPV and the IRR. Both NPV and IRR take into account the time value of money. If two projects are mutually exclusive, which decision-making criterion will help you make the best decision about which project to accept? Net present value, NPV. When only one project can be chosen, the PI is not useful because it does not indicate the dollar value that a project will add to or take away from a firm. Why might a firm prefer to raise debt capital through bonds instead of stocks? Bonds do not require a firm to give up any ownership. This is attractive to a firm that needs funds for a project but wishes to maintain control. Why is it appropriate to calculate the value of a bond in the same way that the present value of an annuity is calculated? Bonds pay a coupon every 6 months, pay a constant coupon amount, and have a maturity date. Bond cash flows are an annuity, a constant amount paid every period. The cash flows that come from owning a bond grow at a constant rate every year, and the payments continue. For why is it important to consider the cost of capital in an ideal evaluation method of capital investment? Because cash flows for a project may be uncertain. What must be determined in order to compare the values of two projects with differently timed cash flows that does not need to be determined for projects with similarly timed cash flows. Opportunity cost must be determined to analyze two such projects. What is the disadvantage of debt financing? Debt financing does not actually achieve an optimal capital structure for a company. Debt creates a tax shield, but there should be a mixture of debt and equity in an optimal capital structure. Debt financing creates a tax shield disadvantage. How do you factor sunk costs into capital investment analysis? For the purposes of analysis, sunk costs are irrelevant. Sunk costs are costs that have already been incurred whether you choose to do a project or not. Beckingham Sports is an American sporting goods company. Based on a $400,000 market study and a $600,000 fee for consulting spent prior to the project, the firm can increase its annual operating cash flow by $3 million by selling overseas. Because the firm was considering the expansion, it spent $2 million to purchase a land for new factory and equipment. However, someone is making an offer to pay the company $3 million for the land it purchased for the new factory. What is relevant to include in the company's capital budgeting decision? $3 million for the offer price of the land. If you do the project, you will miss the opportunity to sell the land for $3 million. This is an example of an opportunity cost. Why is NPV the most reliable method for evaluating investments? It considers the time value of money. It tells you the dollar value that the investment will add to the firm, and it takes risk into account. Suppose you are a manager at a firm. One of your financial analysts places a report on your desk of valuation calculations for some potential investment projects. When you look at the calculations later, you notice that the analyst did not indicate if she used the NPV or IRR method. However, you do notice that the results of the calculations are all percentages. What can you conclude? The analyst used the IRR method. IRR calculations are represented as percentages because they are rates of return. You are considering a project that has a profitability index of 1. What does this mean? The project has the internal rate of return equal to the cost of capital. TI equals 1 means that the break-even point is the estimated cost of capital. In other words, the cost of capital and the rate of return should be exactly the same. You just purchased a bond for $1,000 that has a par value of $1,000. What type of bond is this? A par bond. The market price of a par bond is the same as the par value. Why is it appropriate to calculate the value of a preferred stock in the same way that you would find the present value of a perpetuity? For a preferred stock, a fixed amount is paid forever to compensate the investors. This is the case for preferred stocks, which are a type of perpetuity. Why is it important to consider the time value of money in an ideal evaluation method for capital investment? Because the value of a cash flow today is different from the value of a cash flow of the same dollar amount in 10 years. Which scenario correctly describes opportunity cost? Alexandra decides to spend $50 on some new clothes instead of using that money to pay her electric bill. The opportunity cost is having the electricity turned off. How does management choose between two projects that are seemingly the same? Management can analyze the different inherent risks that change the cost of capital to the firm. Which term describes the reduction in sales of a company's own products due to the introduction of another similar product? Cost of cannibalization. The cost of cannibalization is the reduction in sales of a company's own products due to the introduction of another similar product. Which item is considered a sunk cost? The consulting cost spent 3 months prior to the start of a project. Since the cost was incurred before the start of the project, this is a sunk cost.